Hi, and thanks everybody for joining us. Just to give a quick overview and history of the firm. It was founded by three of us, friends and colleagues. And there's me on the left there, co-founder and co-CEO, and had slightly more hair. My two other co-founders, Harry Adams, co-CEO, and Andrew Egan, managing director. We previously worked together at a firm called Schneider Foreign Exchange. We left there in 2011 to form Argentex with the backing of Pacific Investments, which is the family office of Sir John Beckwith. So just as a snapshot of who we are and what we do, we are a deliverable foreign exchange broker. We cater for commercial transactions only to a predominantly corporate client base. So essentially our clients are financial institutions and companies who have one currency and need to change it into another one. Only about 2% of our revenue comes from private clients. We don't facilitate speculation. We trade spot, forward, and FX options contracts for clients. We don't take on any house positions, so we don't allow our clients to speculate, and we don't speculate with our own money at all. So our revenues derive purely from the spread. On the right-hand side of this slide, you'll see the evolution of our revenue on a financial year basis. And this really also underpins why we concentrate on the corporate market. You'll see that the vast majority of our revenue is repeat business. So just quickly how we work, we do not operate what's called a 360 model, which is where the salesperson who signs up a client will then go on to manage that client relationship moving forward. We split the front office into two teams. We have a sales team whose job is purely new business. And once they sign up a client, they pass it on to the dealing team, who really their job then to manage the client and their exposures moving forward. Sales team, we recruit from grassroots. So we'd like to train people from scratch to sell our way. It does lead to quite a long learning curve, which I'll come on to in a second. They're remunerated mostly by a commission, which is anywhere between 10 and 17.5% of the gross revenue that they produce in any month. And importantly, they're paid for life of the client. So for a salesperson who signs up a client in year one of their career with us, they're still going to be paid if that client's still trading with us and they're still employed with us in their fifth and sixth and seventh year. So you can imagine that they're quickly producing quite a significant annuity stream. What determines where they get paid on that sliding scale of between 10 and 17.5% are new business targets. So that really incentivizes them to get out of bed in the morning. The dealing team will have a minimum of 10 years experience. They're all regulated to give advice where appropriate, and they receive a flat commission of 10% of the revenue. Experience has shown us that one dealer can look after approximately 200 to 300 active trading clients. On the right-hand side in blue, you'll see this is the evolution of the learning curve that I mentioned earlier. And this is the expected annual revenue generated per salesperson. This is based on historical data that we have. So, you can see that it takes 3-4 years for somebody to start producing significant amounts. But once they have reached that hurdle, then, as I mentioned, they very quickly develop an annuity stream. It's very hard to walk away from. And in essence, they're creating their own LTIP. There is survivorship bias inherent in these figures. Attrition is high, as you'd imagine. It's about 1 to 3, but 80% of that attrition occurs within the first 3 months of their employment. So looking at our addressable market, this really shows where we're winning clients from. A recent survey shows that 85% of UK corporates are using only a bank for their FX needs, and our experience would back that up, just in the fact that the majority of clients that we win business from have only previously really been using their bank. So our typical clients have an FX exposure of somewhere between, we target a few £1 million per year, up to a few £100 million. Once you get below a few million, the clients tend to be catered for by some of the smaller retail type brokers, the ones that you'll maybe see at the airports changing holiday money, or private client brokers who are dealing more catering for that market, people buying houses abroad. On the left-hand side here, you'll see micropayments platforms and challenger banks. These are your Revoluts, your TransferWise, Monzo, people like that. Micropayments and the tech space is something that we have absolutely no interest in. It's a very price-sensitive end of the market. There's an awful lot of competition. It's not an area that we're going to be looking in. On the right-hand side, once you get up into the few hundred million exposure mark, the clients tend to be very well catered for and have things like revolving credit facilities with a syndicate of banks. Very occasionally, we pick up some business at this end of the market from the likes of Goldman Sachs and Deutsche Bank. But realistically, if we're picking up business from somebody like that, then the client is probably being very well looked after and they're outside of our risk tolerance and not our key target demographic. And so who are our clients? Simply mentioned before, financial institutions and corporates that have a commercial need to change one currency for another, and that's either now or in the future. And this pie chart on the left is just demonstrating and showing where that revenue came from. And this is based on revenue from the end of our last financial year. 33%, the big blue section here, is financial services. That's essentially anything that appears on the FCA register. Other, it's worth noting, is the second biggest segment, and that other segment is made up of 26 different sectors. Having a diverse client base is very important for managing risk, having both buyers and sellers of all major currencies. It also means we can make money with every market move and in most market environments as well. For example, UK exporters are more likely to trade when the pound strengthens and vice versa for importers. And this is really just a snapshot of some of the key performance metrics that we look at, take away of our track record to date. And on the right-hand side in blue, you can see that we had 1,212 trading corporates for last financial year that traded 12.1 billion sterling with us, producing 28.9 million of gross revenue. So it's a good time to be speaking with the release of our interim results today. You can see the headline figures in gold there. Performance has been driven by temporary client trading pause. We come onto this in a bit more detail in a bit. We are very importantly seeing signs of a recovery back to far more normal levels. We saw it in September and we've continued to see it post-period end as well. The fundamentals are very strong. I'd actually go as far as saying that our fundamentals of our business are stronger than they've ever been. We actually saw a record rate of client growth in our second quarter. Really, we're just building on the growth foundation with new hires and moving into new premises, which we completed over the lockdown period. Interestingly, the reduction in turnover came in a very interesting way. Average spot size trades were up. Average forward size trade was also up. Interestingly, the spreads also remained stable, so we're not seeing any price pressure. Actually, the average spread increased by around about a basis point. We also, as I mentioned, signed up a record number of new clients, and we had a record number of clients, actually new clients trading with us in our Q2, fiscal Q2, which is calendar Q3 is said here. There was 202 new trading clients over the whole 6-month period. This is the P&L in a bit more detail. And really, the key takeaway here is that this is a period where we've really capitalised on what we set out to do at IPO, what we said we were going to do, which is expand the capacity in the business. And we've done that through investment in moving to the new office, as mentioned, which has given us the capacity to hire more front office staff. Really key takeaway here is the operating ratios. We've been communicating to the market since IPO that we would be expecting a drop in operating ratios down to the low 30%. That was always expected due to an increase in capital expenditure for the new office, as well as obviously the new hires and the fixed cost base there. We've seen it before when we made our first significant office move in 2015, the temporary compression in these ratios from their peak levels that we saw last year. Once the sales staff that we've hired reach their revenue producing potential, we'd expect to see this operating ratio return back to the levels that we were at towards the end of last year, in the mid 40%. That'll be over the medium term, sort of 3 to 5 years. Looking at the balance sheet, really just the key difference from the year end in tangible assets, and that's really just as a function of accounting policy, having to capitalise the lease of the new office onto our balance sheet. There's been a more or less equal and opposite impact on our liabilities. So as a business, really not much has changed from the prior year end, as you can see in our net asset position. We've got a robust capital base, which has seen us through this period very well. We are generating retaining cash, which I'll come on to in a second. And again, we've really invested into the future to really high levels of organic growth that we expect in the medium term. We look at cash, and these are just a couple of the ways that we look at cash. So cash that we report includes client balances, so things like collateral, but also where a client is holding on to a balance and is yet to instruct a payment out. So we strip those out. You can see our net cash position has fallen slightly from the financial year end. That's just as a result of things like the increased capital expenditure, but also we paid out the dividend as well, as we said we would at the financial year end. But we are a cash generative model. In the blue box at the bottom, you'll see that 81% of the revenue that we created in the period is converting to cash within 3 months of the period end. And this is as a result of the revenue mix of our clients delivering cash, which delivers on expiry of the contracts. And we have a pretty stable mix of spot versus forward business, and our revenue has historically always been roughly 50-50. And it's that revenue mix that leads to this pretty stable cash generation. So in these graphs that I'm going to go through now, what I'm really going to go through is set the context for the bedrock of what's underpinning our confidence of a return to normal trading levels, and it's evidenced by the end of the period, but also in the trading activity that we've seen since the end of the period in October and so far this month. And I want to delve a bit deeper into the detail of H1 and look at some of the metrics that actually some of our investors have expressed an interest in viewing. So this graph is really just the crux of our H1. It's our total revenue by quarter, with the relevant period being in blue. You'll notice is that all the charts now are calendar year. Our financial year end is March 31st. So the relevant periods I've always called out in blue. So just looking in a bit more detail, as we've seen, again, relevant period on the right, the FX volume fell quite substantially, essentially saying we've traded less. And that's shown by the graph here with the relevant period in blue. I want to look in detail now at the reason for that drop. And that is it was a result of reduced number of trades in the period. And again, the relevant period in blue, you can see quite a significant drop there. The blue bars, if you look on the right, I've drawn out the relevant period into a more granular detail by months, and you can notice the jump in September, and we'll look at some other metrics that have followed suit, but you can see a significant jump back towards more levels towards the end of the period, and this is something that's continued post-period end. So the number of spot deals fell from about 7,000 down to 6,000. Number of forward deals fell from about 1,500 to 1,400 during the period. And on top of that, the tenor, which is how far forward a client books and hedges their exposure, fell to about 110 days. I'll come on to why that's important in a second. So this graph is showing total revenue by quarter, and look at it in a bit more detail on the right-hand side. And if you notice, really the takeaway here, this is the sign of normalization back towards more normal trading levels. The September 2020 revenue number is 57% higher than the August number. Without giving exact numbers, we've had an encouraging start as well to the start of H2. So why is that? And looking at it in, again, in more detail, we term this temporary decision paralysis by our clients. Because of the nature of our client base, they have a certain degree of discretion over when they want to trade with us, or rather when they need to trade. We had more clients, we traded more new clients. Forward deals we were doing were bigger, spot deals were bigger. We're just doing fewer of them, and that's this decision paralysis. And that's what's borne out in these graphs. On the left is showing in that quarter, the clients that traded, how long had they waited to trade before signing up with us? On the right-hand graph, this is showing the number of new trades per quarter. And you'll notice a very significant jump in both metrics at the very end of the period. And you'll also notice a very interesting interplay between the two, which I'll actually go into a bit more detail on this graph. And that's essentially the last two graphs just smushed together into one chart. So you can see the interplay between them. This temporary decision paralysis leads to a decrease in days to first trade since they signed up. And it might seem a little bit counterintuitive at first. That's actually because clients that have signed up with us but are waiting to trade, they won't appear in the data yet. Now, if we look at the dynamic between the two and look at what happened, for example, following Brexit and the referendum here over 2016, and then compare this graph with the revenue graph that we had earlier. And you can see both the interplay between this and also the impact that it had on revenue immediately afterwards. As the temporary decision paralysis unwinds, as we're seeing here, the days taken to trade jumps, And in this case, at the end of the period, you can see very dramatically. And this is how that pent-up trade that people need to do, that they've just been waiting to do, this is how that manifests itself in observable data that we have. It's also what we're continuing to experience in October and November as well. This short-term decision paralysis leading to depressed levels of trading, followed by increased new client activity, overall activity increasing as well, ultimately leading to increased revenues. When we look back historically, we can see it happening over this period at least 4 or 5 times. So we've been here before. We know how it manifests itself, and more importantly, we know what comes afterwards. And that's really a very strong bounce back to very high levels of activity. There's obviously no guarantees, but this is a very strong indicator to us that this is early signs from September, and trading to date would really support an unwinding of this decision paralysis, which again is obviously helped by the news about vaccines as well. Another very strong indicator for us of client certainty is their behavior when it comes to the forward trades that they place with us. The more certain clients are, really, they tend to put more forward deals on. And you can see how this uncertainty presented itself here in the start of the period with a significant drop in number of forward deals. But if we look over on the right-hand side, breaking out the data into monthly figures, August is always a slow month of cyclical nature. The trajectory is obviously on a very good path and moving in the right way, and September showed a move back towards much more normal levels of activity. And again, that's something that we continue to see post-period end. Actually, as well as number of forward trades, a better indicator of certainty is the average tenor, and that's how far forward a client books. Essentially, clients don't want to book any further forward than they have absolute certainty for. On the right, you can see on a monthly basis, tenor returning to more normal levels, yet again another indicator towards the end of the period. And yet again, this is something that has continued post-period end. At the very left-hand side of this monthly breakdown here, this figure here, 79 days average forward contract, was actually the shortest average forward contract level that we've seen our clients book since 2014. And September's average tenor represents a 53% jump. Now, we can't point to any single one of these metrics and use it as a predictor of near-term outcomes, but taken together, and please do, that's why I put these in here. I put these here for you to take away and look at each graph holistically and in conjunction with each other. In the medium to long term, we're confident that the unwinding we're seeing will translate into higher volumes and ultimately revenues that we look forward to reporting on in the coming time. So moving on, other operational interests that have happened over the period. I mentioned before that we moved offices. We did so. We signed the lease during lockdown, which also meant that the fit-out occurred during lockdown. So we are lucky enough that we're able to fit out in a COVID-secure manner, so we required no retrofitting. This really just is the bedrock of the foundation of investment for the future, and that has allowed us to hire 23 new staff since April, and has given us a 62% increase in number of sales staff since the year end. We have a capacity for up to 140 staff, and that's before any configuration. It's all within the COVID-secure environment. Our overseas expansion has progressed over the period as well. The office in the Netherlands, again, was opened during the period. We have 5 staff members based in Amsterdam. We have Dutch speakers in the London office as well. They're opening a very pleasing number of clients. It's already revenue producing. And looking further afield to Australia, we've identified the individual who's going to be the local responsible manager. And also we've registered the company in Sydney, and PwC are making good progress with our regulatory application. It's a very, very heavily regulated market, which is one of the reasons why it's attractive for us. It's a very good environment down there currently for us to flourish in. The strong regulation does mean that it's a very long route to market. So this really is looking with a much longer term lens. So in summary, you can see the numbers here on the left as per our trading update. Historically, H2 has always been better than H1. We have had an increased number of trading clients, a record number of new clients, and trade counts continue to increase. September revenue was 53% higher than August. We've continued to see very, very strong revenues in the early start of this period, and also the 62% increase in sales staff, really forming that bedrock and foundation of growth for the future. And so finally, just ending on the outlook really there. In the near term, there's obviously uncertainty. There's no getting away from it. I'm speaking to you now from the middle of a lockdown, which we didn't even foresee just a few weeks ago. And the data shows what has happened historically in terms of high hesitancy from clients. really the takeaway here is we've been here before. We know what's happened, and really we know what's coming next. Return to high levels of client activity, FX trading volume and revenue, and as I've mentioned before, October and November certainly supporting the green shoots that we saw in September. And that really gives us the confidence that we have the trading levels are returning to normal and that our growth will resume on the trajectory that we'd like to be able to report in the near term. So thank you very much for listening, and I'd like to invite any questions.
So with regards to sales and dealing staff, are they paid commission only, or are sales staff paid some salary as well? Presumably, otherwise their earnings in year one would be pretty meagre.
Yes, sorry, good question. And sorry, yes, I should have made that clearer. They are paid a salary. We pay obviously, commensurate to market rates, and they're paid a basic salary. But the majority of their earnings are really expected to come from commission once they start producing that commission.
Great. How certain can you be that SME clients have merely deferred their FX trades in half one, as opposed to executing them with a third party, such as their relationship with a high street bank? My concern would be that in the current climate, where high street banks are providing additional liquidity to their clients, a proviso of this may have been that ancillary FX business comes back to that bank. So in essence, how do you determine that trading clients are still live?
That's a very insightful question. Really, that boils down to the crux of the sort of business that we are. You'll remember that I mentioned that as a whole firm, we only dealt with 1,200 corporates throughout the entire financial period last year. What that means is that we're providing a very high touch, high level of service, and we provide it in a old school private bank style way. So our key demographic are clients, really people who want to speak to people. So we're in constant contact with these clients. We're not a merely an execution platform or a venue. We are in constant contact with our clients. And frankly, the reason that we can be sure that the majority of clients aren't going back to their bank, because you very correctly say that banks often do put FX down as a proviso for providing liquidity and loans and things. One of the reasons that we're very sure that that's not happening to the majority is that they're telling us that's not the case. Frankly, that is a reason often why we don't end up working with clients often to start with. Often they're not able to because they're locked in with the bank. In fact, quite the opposite. We've actually noticed over the period that banks are, they're under an obligation to be cautious about their lending, and so we're seeing actually clients come back and ask for more terms. And over the period, it's worth mentioning that we've maintained a very strict risk procedures and systems and controls that we've always had. So we're actually turning away more business over the period from a risk perspective. For example, a high street retailer coming and asking to book $200 million forward for a year and a half, but saying, I don't want to place any collateral. Now that would fall outside of our risk appetite in the normal environment, let alone the current environment. But the frequency of that sort of request and the fact that they kept coming back and asking is showing us that no one's providing them with this liquidity, and that's why it's pent up. They still need to trade it. We know they still need to trade it because we're speaking to them, and they're telling us they need to trade it. And so as things return back towards more normal levels and a bit more certainty, we're seeing people again a bit more willing to start placing collateral and not asking for such strong credit terms that would fall outside of our risk appetite.
Great. What are your plans for investment in technology?
Thank you. That's a good question. We're never ever going to be a fintech business. That's never been our outlook or on our radar. But we have already invested over £5 million since inception in our bespoke software platform that we use. We do have an online system, but it's not seen as a key revenue generator for the business. It's there to provide an additional service to existing clients. For example, somebody who may normally trade tens of millions per trade with us may not want to pick up a phone and speak to their dealer if they're making a very small payment run where really it doesn't matter, they just want to click a button and get it done. We can now just provide that and done with that service. We're not looking to, as I mentioned earlier, compete with the likes of TransferWise and Revolut, who are very tech heavy. In terms of the future, we need to continually obviously invest to keep up with and keep ahead of things like regulatory requirements, reporting requirements. But really, that's just all the expenditure and the investment resource that we put into technology is to underpin our core purpose that we see it, which is to provide this private bank style personal service to clients.
And another question around risk. I know you've answered a little bit on that. How does the statement that the group had to turn down business outside risk appetite reconcile with the group acting as a riskless principal intermediary? Presumably, all transactions are back-to-back and pre-funded, and forwards are margined with principal exchanged.
Absolutely, that's correct. So riskless principal would refer to the fact that we take no market risk. With a forward contract, although there's no market risk, because as the person has very astutely said, we back to back it and also we take collateral. But there is credit risk on the client. So a bad debt would occur if the market moved so that the forward position was out of the money, and then the client was unable to collateralize that or unable to fulfill the forward contract. And so for that reason, that's why there is an upper limit to the amount that we're willing to take on, and why we would turn down $200 million from a high street retailer in any market condition, because it just falls outside of our risk appetite. The market wouldn't have to move very far before that position was quite significantly offside when taken into when taken in perspective of the size of our balance sheet, which is very robust. But nonetheless, we wouldn't want to be overly exposed to any one particular client.
The company's largest top 10 customers represent what percentage of its business?
We actually look at the top 20 as a metric. The percentage has fallen since inception. The top 20 used to be responsible for 80 or 90% near the firm's inception, and that's fallen down to in the 30s or 40%. What's interesting about the dynamic of the top 20 is that year to year, it's not the same top 20 clients. Some clients will appear multiple times across the period, but then they might not trade for a year because they've already hedged out for 2 or 3 years worth of their exposure. So we wouldn't be seeing their data in that year. Looking over the last 3 years, the top 20 has consisted of 46 different clients. And last financial year, out of the top 20, I believe it was 5 were new.
Great, thank you. And how did your people and your systems deal with working from home? And if that continues longer than expected, what might the economic impact be?
Good question. So actually, the operational ability of our sort of business to work from home is very high indeed. We transitioned within 24 hours of the first lockdown to 100% working from home, and our clients experienced no impact on their levels of service at all. We're currently actually classed as an essential business, so we are able to operate. I'm speaking to you now from my office, and a good proportion of our staff are actually in and working. Having said that, though, a good proportion are working from home as well. We are able to work from home very, very efficiently, and that's actually goes back to the earlier point about the investment in technology. We're lucky that having the bespoke platform that we have enables us to do so very, very efficiently. In terms of impact, the one role that can't be done remotely is new sales staff, the training of them. From both from a compliance and governance perspective, we just couldn't allow a new cohort of sales staff to start the job having never met them and actually never trained them face to face. So if we are looking at extended periods of continued lockdown, the economic impact of that would come from our inability to hire further cohorts of new sales staff. Worth noting that all of the sales staff that we hired with us next door on the sales floor in a COVID secure environment, obviously, and the sales team are all enjoying being in the new office and learning from each other. So an extended lockdown, yes, it would delay our hiring plans, by the way, which we probably expect to hopefully hire the next cohort lockdown dependent towards the end of Q1 next year, calendar year. But yeah, that would be the main economic impact. In terms of how we operate and our ability to service clients, we saw very little impact at all, if any.
Thank you. Hasn't the time for pent-up demand passed now? If businesses have done less business during the pandemic, they are unlikely to backdate their demand moving into the next period. Isn't it more likely that they're just going to return to normal levels?
I think a combination of both, actually. The degree of discretion that some of our clients have is quite significant. And if you look at the data and the degree of the jump that you saw there, that's not just normal levels. That's a coiled spring coming back to beyond normal levels. A good example of extreme levels of activity that we can speak about because it's historical. The last 2 March periods that we've had have been very, very extreme. So they've actually been our 2 best months to date because of the sheer volume of demand from this sort of contraction and expansion in their demand. And to the point of how do we know that it's not going to return to more normal levels? Well, they will return to more normal levels, but they haven't been able to do what was normal for them in the last 6 months. So they still need to buy as many dollars as they did before. But they have the degree of discretion of when to do it. So there will come a point where they have to pay their suppliers, and maybe they might have covered that off in a forward contract in more normal times earlier on in the year, but now they're just waiting to a bit more certainty, and that is what the data is showing is returning back to more normality.
And is there a concentration of revenue in a handful of star brokers, or is it fairly well spread?
There is a concentration of revenue, and the Pareto principle of 80-20 exists in the business. In terms of sales staff, but that's really a function of how long they've been with us. Our key sales staff, as I mentioned earlier, they've created a revenue stream that'd be very, very difficult for them to walk away from if they wanted to go and start again somewhere else. Also, we've incentivized key staff with long-term incentive plans so they can participate in the success that we expect and return to shareholders over the medium to longer term. And it's also important to remember that the salespeople pass on the relationships onto the dealing staff, and the revenue is much more evenly spread across the dealing team. Again, key members of staff are being incentivized there. And again, they have a revenue stream and a base that really means that they have a very nice life of it.
Thank you. And how does your experience of market conditions compare with competitors on aggregate volumes, given the high volatility and uncertainty? I would have thought the appetite for hedging would have increased.
Very good question. I can't really speak with too much detail on competitors' requirements. You're absolutely right in that the uncertainty can lead to an increased demand, and that's really the spikes that we saw at the beginning of the situation. That fell into last financial year, so we generated over 5 million sterling of revenue just in March, but that was right at the end of the last financial period. What we see following that are really the other type of finance directors. So you have the finance directors who, in a period of heightened uncertainty and volatility, want to get rid of that uncertainty and they hedge immediately. And then you have the other type that want to play out and ride out the uncertainty, because if they can't be certain that they're going to need their currency, they certainly don't want to jump in and overbook and overhedge and end up with a need to buy currency that they have no commercial need for.
Perhaps this is more relevant to the larger institutions, but with global interest rates at or near zero, economic fundamentals will likely be reflected in currency movements. Do you or your clients agree with this? Would this result in an increase in levels of foreign exchange activity going forwards?
I actually don't think it will result in an increase in levels of FX activity over the longer term, because what drives our flows of FX and therefore our clients is really just the amount that they need to commercially hedge. We're not a speculative FX house, so the increase in global interest rates as they occur would cause heightened volatility. Now, that might shift decision points of trading for those clients, as we've already spoken about, who have an ability to defer decisions to trade or bring them forward. But so it might make the revenue line more volatile, as we've seen across our trading history in previous periods of market uncertainty. But taken out in the long term, what you've actually just hit on there is the exact reason why we're very confident over the medium term that things will return to normal, because they have a need to hedge and have a need to buy a certain amount of currency, and the volatility is not a driver of that.
Thank you. And moving back to staff, if a staff member leaves, does their lost commission revert to the firm or go into a staff pool?
It goes to the firm.
Great. Thank you very much, Carl, and thank you all for joining.